My name is Nitesh Nath. I am the founder and CEO of DFlow. Today's talk is about internet native market structure. So kind of before I dive into the thesis, and the talk will be slightly technical, going over some market structural things in traditional financial markets as well as decentralized financial markets. Before I get into that, a little bit about DFlow. So DFlow is a Solana DEX aggregator. Primarily, we do two things. We build sort of this giant real-time graph of DEXs, prices, and liquidity on Solana. And two, we spend a lot of time doing sort of optimization problems in low latency software, calculating optimal trade routes between two tokens. This is slightly different from how things work in the Ethereum world, where routing is done on-chain typically. We do all of our routing off-chain in Solana land, and then construct sort of like transactions that are then returned to wallets. So concretely for us, as a DEX aggregator, we have two sets of sort of market participants in our system on the taking side and the supply side. So supply side is liquidity from a lot of these sort of like DEXs and various on-chain liquidity providers. And then sort of the other side is the wallets and wallet APIs. Okay, cool. So let me talk to you a little bit more about what I like to call internet native market structure. This is one of the reasons why I got into crypto in the first place in 2021. My background is in high frequency trading, so was fairly well versed with sort of this pattern that has emerged in trading over the past 3 or 4 decades. A lot of trading used to take place in sort of like the pits of Chicago. And what we've noticed is that every time there is a sort of like new substrate or new medium for price discovery to happen, market structure changes very, very drastically. So, decades ago when trading happened in the pit, that was prior to the introduction of electronic order books. After trading moved to the electronic order books in the 2000s and 2010s, lots of things changed. There was the emergence of brand new types of trading and trading firms. This is when Citadel Securities and the Jumps and DRWs of the world started becoming very big. In the 2010s till the sort of like end of the 2010s, there was this massive latency race where all of these firms were trying to compete on sort of like landing their orders to the matching engine, which was a very centralized thing. In sort of late 2010s, and obviously, Bitcoin came around during early 2010s, but in the late 2010s and what we have been seeing in the 2020s is the emergence of like a brand new type of substrate for price discovery. And it's this incredible phenomenon that buyers are meeting sellers permissionlessly on the blockchain. And I think this is, again, this is a phenomenon. It's a completely novel phenomenon, but I don't think we're going to start to see the long-term effects of what happens over the course of the next several decades until probably later in the 2020s. So this talk is a little bit of history behind what has existed and some predictions about what the future might look like. So this is a very gross oversimplification of traditional financial market structure, but the purpose of laying it out sort of in the constellation of these three entities is to talk about how retail interacts with these markets. So to date, what we've found in DeFi is that retail is the primary participant of these markets, and a lot of these systems are designed on, at least with what DFlow thinks about, of protecting retail. So this is a very retail-centric view on how trading happens with markets that retail has access to. So US equities typically in traditional markets. So the three entities that we have here are exchanges, makers and takers, and brokerages. So exchanges are centralized entities. They hold matching engines. This is all stuff that you guys are probably familiar with. And they allow makers and takers, so the Citadels, Virtus, Jumps, DRWs of the world, to co-locate and trade on these centralized venues of price discovery. Now, where retail comes into the picture is with brokerages. So retail will typically use consumer-facing applications built by companies like Robinhood and Schwab. And retail will generate a lot of very soft order flow that the market makers love to have and the exchanges also love to see. So the flow of sort of like order flow originates from brokerages, is either internalized by the makers or directed to third party like the New York Stock Exchange, various dark pools, things like that. So in DeFi and in particular on Solana, which is where DFlow focuses, and so what I think about the most, you have a slightly different structure. So you have first the aggregators, which is what DFlow builds. You have aggregators in traditional financial markets as well, but they play a slightly different role. So you have aggregators in DeFi. They aggregate liquidity from AMMs, which are liquidity providers, so market makers effectively. You have takers, which are MEV sophisticated actors, and these are typically actors that would like to take resting liquidity in order to profit, pick off the makers and AMMs that are resting liquidity. And then you have wallets. So wallets are, again, from the retail-centric view of how we like to view this market structure, the primary place where retail interacts with the liquidity on-chain. Wallets generate a lot of very soft order flow, similar to the brokerages in traditional financial market structures. However, the flow generally goes through aggregators and is executed by the AMMs. Cool. So the thing that I want to highlight is DEX is a misnomer in this sort of like new decentralized market structure. DEX has the word exchange in it, so you might analogize it to the New York Stock Exchange or NASDAQ or something. However, this is actually a misnomer. I would argue that a DEX is not actually an exchange. They're just a market maker. And on Solana, we're noticing a trend of AMMs that have become proprietary. So, typically the Uniswaps of the world provide liquidity via capital that is deposited into the smart contracts natively on chain. On Solana, we're noticing this very interesting trend of proprietary AMMs that are run by sophisticated makers that are generally model-driven, predictive of future prices, and very sophisticated, similar to the MEV sophisticated takers, with moving their quotes out of the way on block space. Now, the reason this is important is because market structure in DeFi today is very imbalanced towards takers. This is inherent to the type of trading that market makers do and market takers do. So with market makers, they are resting their liquidity at all times on-chain on Solana. And market takers are opportunistic, meaning they don't actually have to trade until they choose to. So with market makers having risk exposed and sort of like DeFi blockchain market structure allowing validators and searchers to have sort of like privileged permissionless access to market maker liquidity, this balances the favor of this market structure very heavily towards takers. So what we are noticing with proprietary AMMs, which don't allow capital deposited from retail, is a divergence from takers being the only ones who are sophisticated about accessing block space. What does this actually mean? This is a very early sort of like predictive thesis that I have on the future of Solana DeFi in general, which is that once you start seeing sophisticated makers in a system, this is a very early and strong signal of impending DeFi growth. Now, the reason for that is because these prop AMMs in general are competing for order flow from these wallets and just generally any order flow on chain in a way that is economically incentivized, meaning the makers actually earn P&L rather than just charging a fee. They capture the spread, and then so they set the spread very dynamically and purposefully. And they price the market in a way that is also sophisticated. So they're actually trying to quote around a fair price proactively rather than retroactively, which is what like the passive AMMs like Uniswap do. So because you have this effect of these prop AMMs tightening to the spreads in the market, trading becomes cheaper. Every time a user wants to trade, they pay less. Now, on an individual sort of like trade by trade basis, if you look at this, sure, they're saving 1, 2, 5 basis points. Not really meaningful when you look at it sort of like individually, but aggregate this over 12 months, and this is a lot of savings that are either redirected back to users or distributed back to protocols for the use of better applications. So what happens is if over the course of 12 months, users are saving a lot of money when trading, they're going to have more money left to trade. And, the cost of trading, if it's cheap, then there's going to be increased trading. If there's increased trading, market makers who earn P&L from basis points times volume, if volume increases, then there's more P&L for the market makers to have. If there's more P&L for the market makers to have, there's going to be increased competition. Increased competition leads to tighter spreads, and the whole cycle repeats. And there's a very strong byproduct of this DeFi growth loop, which is that as more trading happens and more users arrive to the ecosystem, there's more protocol revenue and there's more application revenue. REV is sort of like one metric of this that is either reinvested into protocol development or redistributed by protocols to token holders in some form of the other. This is also sort of like this other growth loop that feeds into this the previous cycle shown on the previous slide. So reinvested, redistributed, increased user activity, and then more apps and more protocol revenue, more improvements to app UX, and more protocol revenue. Okay, so what does this actually all mean? I probably actually should have just put Solana DeFi will surpass TradFi, which is the main purpose of this talk, is to highlight the fact that a lot of the reasons many people entered crypto in the first place was to compete with traditional financial markets, build sort of this new system on a blank slate. And I think that over the next couple of years, it may not be so obvious today, we are actually on track for that. I think DeFi will surpass TradFi. It's this completely novel market structure where instead of submitting orders to a centralized matching engine, makers and takers are deploying their own contracts on chain. They're doing so in sort of like this Turing complete language, which is the language that the smart contracts are written in, and the barriers to entry are very low. So competing for flow is as permissionless as doing anything else in DeFi. You deploy a contract, you submit a bid offer, and if you are the tightest bid and tightest offer at any given time, you win some flow. Right, so that's the headline. Solana DeFi will surpass TradFi, and this is something that we are extremely focused on at DFlow. Yeah, keep an eye on us. We launched at the end of Q4, had a great Q1, integrated with Phantom, Jupiter's front ends, Camino Swap, major applications, and a lot more to be announced next quarter. Thank you.